So in this context, we can look at both the return, which is the slope of these lines. So we can see that the returns of our short-term bonds and our long-term bonds are considerably less than the returns of our equity investments. And we can look at the risk involved in making these investments, and that risk is the variation in the return. So that risk is the amount that of what's the best way to say it? The amount of how squiggly these lines are, I guess. So you can see that the Treasury bill line is completely straight. There is almost no risk involved in making short-term loans to the U.S. government. You can see that the risk involved, the variance in return, the risk of a long-term government bond is also small, right? That line is pretty straight, especially relative to the stock lines. Notice how much jumping around the stock investments do. You have the period here, which is, you have the period here between, 1920 and 1938 or so, which incorporates a huge amount of up and down and up and down as we go through the Great Depression in the U.S. Lots of loss, lots of gain, lots of loss. There's another big period here in the 2008 crisis where we see lots of gain and up and down and up and down. And we can see that even more if we look at the shorter time horizon. So when we look at a shorter time horizon, we see that the risk here is much, much more obvious. The line for a short-term government bond is still almost straight, but the lines for everything else is still is more significant, right? There is a lot of up and down and up and down and up and down. That's risk in investing. Now, the slope in these lines is still positive. Right, so we are still making money overall, but we are experiencing wild swings in how much, in a day-to-day basis that is reflecting the relationship between risk and return. Now, what we want to do is to think about how we turn what we know about the past relationship between risk and return into a model. And the simplest form of a model is the line, right? Y equals, oh man, this is bad, X plus B, right? So if we model the relationship between risk and return as the slope of the risk-return line that we're seeing here for equities, we start to approach the way, or the logical way, that we come up with the model that we're eventually going to use, called the capital asset pricing model, right? This is more or less the way that we start to come up with this model. So that's why we in this class, that's why we care about looking at these historical returns. One of the other things that we can look at is this over the last 200 years, right? Now that graph is only 100 years, but stock markets in the U.S. are 200 years old, the New York Stock Exchange is at least. So we have data going all the way back 200 years, so we can look at an even bigger period of history. There are markets, stock markets in the UK and the London market, and in the Netherlands, the Amsterdam market, go back almost 400 years at this point. So we have a huge history of these historical returns to help us understand this relationship. And so if we look at a longer history, we can see that, in this table here, the sort of historical relationships between these portfolios and return, right? So small stocks return on average about 17% a year. Large stocks on average about 12% a year. Long-term corporate bonds about 6%. Long-term government bonds a little bit less than 6%. Short-term government bonds almost 4%, and inflation about 3.1% over that time. Right? So it's still approximately the same relationship, just a little bit different numbers when we have a little bit longer time horizon. Now, what I think is pretty interesting is that if we look at, say, the best holding period returns over this time horizon. So 1926 to say 2005 or so. Right? So holding period return is the total return you would earn if you bought one of these portfolios and held it throughout an entire period. If we look at the best 5-year period, we can see that the best 5-year period happened between 1995 and 1999, which is during the dot-com boom, right? So the average annual return during that 5-year period was 28.6% per year, while the holding period return for that 5 years was 143%. So if you invested $1 in 95 in the stock market and held it until 99, it would be $143. Right? It grew, huge amount in that time period. Oh, sorry, not $143. 100% is just doubling, but still, you would more than double your money. The worst 5-year period happened during the Great Depression, 1928 to 1932. The average annual return during the Great Depression was negative 8%, so you lost 8% a year. And the holding period return over that 5-year period, so your total return, was minus 41%. So you lost about half your money during that period. But if we look at just a 10-year holding period return, so the best 10-year holding period return was 1949 to 1958. So just following World War II, what we call the post-war boom era, the average annual return was 21%, so still pretty damn good year over year. And the total holding period return over those 10 years was 213%, right? So you tripled your money. Pretty damn good for 10 years. What's crazy, though, to me, what really reinforces this relationship between time and investing is that the worst 10-year period you could have in those 100 years, 1965 to 1974, which is our Vietnam era, right? That's the worst. The worst you could do was 2.48% per year. So you made money, and your holding period return was 25%. Right? So not great money. The best 10-year period you make 200%, but in the worst 10-year period you still make 25%. You're not even losing money. Right? So if you are investing in a 10-year horizon, you are essentially, you can never say guaranteed, but at least in the history of the U.S. stock market, you have never lost money. If we look at a 20-year horizon, the best 20-year horizon was 42 to 61, so surrounding the World War II and the post-war boom era. Your annual average return was almost 18%. The holding period return for 20 years was 350%. The worst one, though, 1929 to 48, so that incorporates most of the Great Depression through World War II. In the worst 20-year period in the U.S. stock market during the last 100 years, you made 6% a year, and you doubled your money, 120% holding return. Right? So it's all about time. If you leave it in there long enough, the risk washes out, and we end up only capturing the slope part of that model. We just capture the upside because the day-to-day variation in the risk, it is washed out by the next period, which is awesome. Now, as we try to start to think about a model for risk and return, this relationship, right? We looked at this sort of linear first attempt at a model. We saw that there is a relationship. We saw that, that all of these different portfolios have different returns, right? Small stocks earn a higher return than the short-term treasury bills, right? Short-term loans to the U.S. government. What we want to think about is, if we're going to create a model that explains the relationship between risk and return, is why do small stocks earn more than large stocks? And why do large stocks earn more than long-term corporate bonds? And why do long-term corporate bonds earn more than long-term government bonds? And why do long-term government bonds earn more than U.S. Treasury bills, right? So why is there variation in return? And the answer is that we understand that risk defines this variation in return. Risk is why there's a variation in return. It is more risky to loan the government money for 30 years than for 3 months. That's why there's we earn more in a long-term government bond than a short-term bond. It is more risky to loan a company money for 30 years than the US government, which is why we earn a little more to loan companies money. It is more risky to own shares in a really huge corporation than it is to loan them money because, well, we've talked about this throughout the other lectures, but of course, it's more risky to be an equity holder than a debt holder because a debt holder has claims, physical claims on the assets. So there is some ability for recovery, right? A debt holder is, companies borrow against their assets, but when we buy shares and ownership shares, we don't get similar promises, right? And it is more risky to own stock in a smaller company than a larger company because a smaller company is less financially stable, probably, and on average, and so it has less access to capital, and so there's a greater possibility that a small stock, an investment in a small company, goes south. So the variation in the risk that we take is what distinguishes the amount of return. Now, that means that the levels of risk that we were just looking at aren't necessarily reflective of this true relationship between risk and return, because if we think about the way that that we just defined the variation in return, we defined it as, right, that it was that you make more money for taking on more risk. Well, the thing with the least risk, in fact, the thing that we consider to be no risk, is a short-term government bond. Right? So a U.S. Treasury bill is something that we consider to be basically zero risk. And then if we think about the extra risk that we take on for investing in any of these other categories of investment, we can call that extra return that we generate a risk premium. Right? So this is the premium that we earn for taking on risk. So if we take on no risk, we earn no risk premium. That's just called the risk-free rate, and we typically associate that with a treasury bill. And so a treasury bill is the risk-free return. We call that the risk-free rate. If we take on any more risk than a treasury bill, we call that a risk premium. And so what we really want to be looking at is the risk premiums of each of these levels of investment. Right? And so the way to do that is simply to subtract the U.S. Treasury rate from all the other returns. So if the average return for a long-term government bond is 5.8% and the average return for a U.S. Treasury bill is 3.8%, then the risk premium that we generate or earn for loaning money for a longer time is 2%. And the risk premium for a long-term government bond is 2.4%. And the risk premium for a large stock is 8.5%. And the risk premium for a small stock is 3.3%. Okay? And these are the historical numbers that people will tell you that stocks earn. Right? So if you are talking to someone and they're saying on average a stock is going to earn 8% a year, what they're talking about is the risk premium. Risk-adjusted return is another way to talk about the risk premium. Right? So 8.5%. So you could take the risk-free option, which is a treasury bill, but if you want to take on some risk and you invest in the stock market, then you're earning somewhere between 8 and 13%, depending on what category of stock you're investing in.